Recent rise in bond yields proves to some that the equity markets may be a little overextended. There's certainly some concerns that despite the vaccine rollout, the economy may not support the recent market buoyancy. Are we due for a market correction sometime in 2021? Well, joining us now to discuss this, Julian Chillingworth, Chief Investment Officer at Rathbones, and Thomas Pugh, UK economist at Capital Economics. Gents, thanks indeed for joining us. Julian Chillingworth, I wanted to start off with you, if I can, to begin with. How do you describe the markets at current levels?
Good afternoon, Jeremy. Well, markets I would describe as jittery at the moment, quite frankly. We've seen, as you referenced, a backup in the 10-year bond yield. It was around 148 when I came on. And I think that what's going on is that investors are worried that as economies open up, we will see fiscal packages, particularly in the States, pushing a lot of money into the system, and inflation may become more of a concern as we go through the year. And the question that the bond markets are asking is, could we see a preemptive early rising rates from the Fed when they least expect it? Hence the nervousness we're seeing around bond markets, and that's then reflected back into the equity markets around the world. And we've seen a little bit of a tantrum, not quite as bad as in 2013, but definitely people's resolve has been slightly shaken.
Do you see that as the biggest risk, or do you think that markets generally are overvalued and there should be some air let out of the tires?
I think that as we go through this year, and hopefully we see pretty strong performance in terms of economic growth coming out of the US, and the European and UK economies beginning to gain a bit of traction, I think we will see profits pick up, and some of the more stretched valuations that we're looking at now, particularly in the cyclical area, and some of the financials will begin to unwind. I think that you could argue that obviously a lot of the good news you referenced, vaccines being rolled out, has been priced in early in the year, and it will be no great surprise to see a bit of a pause in markets. But overall, I don't think we're that concerned for the year as a whole, and we continue to like equities and risk assets more generally.
Thomas Pugh, I'd like to bring you in, if I can, and talk a little bit more about the economic backdrop to this. What are your thoughts on where we are economically? Julian there talking about inflation and growth as well, and of course the vaccine rollout that markets are now obviously beginning to price in if they haven't already done so. Where are we economically?
Hi. Yeah, well, I think probably most of the bad news is behind us. We've done most of the hard work. The rollout of the vaccines, as we've just talked about, is going really well. That means that these COVID-19 restrictions can start to be eased a lot earlier than many had anticipated. And it will allow the economy to really pick up probably from the middle of this year, June, July. After that, we think that the economy is probably going to be back to its pre-crisis level by the start of next year. That's about 6 months quicker than the OBR had in its forecasts, which were released yesterday. All of that will be good for the profits and earnings, particularly of cyclically consumer-facing businesses.
What about the outlook for inflation, though? Is that something that we should be concerned about, Tom, in terms of the economic backdrop? Without large amounts of growth, having inflation is not particularly good, is it?
No, I think there's probably two things to unpack here. The first is that even though we think the economy is going to recover rapidly over the second half of this year and next year, there's still going to be a fairly large amount of spare capacity in the economy. Now, that's going to put a lid on how much inflation can really rise. The second point is, even if we do start to get a little bit of inflation picking up in the system, we already know there's going to be a rise in inflation this year due to the previous rise in energy prices. The Bank of England have already said they're looking to see sustained inflation above 2% before they even think about raising rates.
Julian Chillingworth, what does this mean for earnings? We've got companies, as indeed, of course, is the government, the country, in quite a lot more debt than we have been previously. A lot of companies, of course, are taking on debt. There's been a lot of concerns about how companies are piling up balance sheets. Do you see a rise in interest rates as a serious headwind for the markets?
Well, obviously, if we saw central banks raising short rates anytime soon, I think that will be a headwind. But as Thomas has just said, referring to the UK and to the United States, which I was talking about earlier, I think any rise in rates by central banks is highly unlikely in the next 18 months to 2 years. And referring back to inflation as well, I think that the markets generally can function quite effectively and will hold their levels as long as inflation remains below about 3.5%. I think above that level, looking historically, that's when markets begin to get the jitters. And I think that the Fed has been very clear that they will not be unseated by a short-term spike in inflation. And we're going to hear from Jay Powell again shortly, and I suspect he's going to reiterate that message once again. And the same message is coming out of the Bank of England as well. So I think from that point of view, it's not an area of concern. But for companies generally, those that are more highly leveraged, yes, are obviously always going to be concerned about rising interest rates. But you've got to remember that certain areas are very successfully functioning in the UK, where they actually aren't carrying a lot of debt. I mean, referring to things like the materials sector, to areas in some financials as well. Oh, yes, in the hospitality area, yes, there is debt, and there's going to be more debt. But that's just one segment of the society. Other areas are performing reasonably well and not that burdened down by debt. So I think earnings can come through and things will look better.
You're painting a fairly rosy picture as we see things at the moment. Do you hold anything back just in case there is a market downturn? Do you price this in at all at these levels? Do you think that we are due for a little bit of a pullback or retracement?
Yeah, I mean, I genuinely think that, that if we were to see the long 10-year go to 2% in the US, then yes, I think we would see further selling of tech and growth momentum plays in the US, and we would see investors get decidedly jittery. I mean, we've seen in the last month or so the jitters as we've gone to 150 on the 10-year. So no, I don't deny that's the case. I would say to you that we are looking at keeping our allocation to equities and risk assets more generally at above our neutral level, but are keeping a bit of firepower back because there could be some great opportunities, be it at the sector level or more generally at the geographic market level.
It's interesting, Tom, listening to what Julian was saying there about the backdrop and yields. Here in the UK, I think yields on 10-year are about 0.75, and I believe they're talking around about 1% as the tipping point, if you like. Do you think we're going to get to that sort of level anytime soon? Is there a risk that this uplift in inflation is going to steer bond prices higher far more quickly than maybe people are pricing in here?
I mean, there's always a risk. We think that 1% is probably about the top. We don't think there's a huge amount more further for gilt yields to go. And that's largely because of our view on the Bank of England. As it becomes clear that the bank's not looking to raise rates, as it becomes clear that inflation probably isn't going to be a massive issue over the next year, 18 months or so, some of those upward pressures on gilt yields are going to fade.
What about the consumer here, Tom, and how the consumer is feeling? I mean, I'm thinking mainly of some of those domestically orientated companies, certainly those in the leisure sector that's been beaten up, the retailers and so forth, and banks that have exposure to the consumer. What's the consumer looking like as we go through to the back end of this year? If, as we hear from the Bank of England, that we do get these inflation numbers coming through to somewhere close to the Bank of England's target at 2%, how is that going to impinge on us as consumers within society and our activities?
So consumers as an aggregate are in a really good position at the minute. They've really used the crisis and the enforced savings that they've had to make over the last few months to pay down debt, to build up cash savings. So as soon as the retail hospitality businesses are reopened, there is a big pool of cash there available to be spent. The government has spent a fortune on the furlough scheme, supporting incomes. All of that puts consumers in a really good position to be able to spend. Admittedly, there is an issue that a lot of these cash savings are held by higher income people who are less likely to save them. Less likely to spend those savings. But as a whole, the consumer sector is looking pretty good, and that bodes well for those consumer-facing companies. And that is the main driver of the recovery over the next 6 months to a year. Is the consumers going out, spending, making up for that lost time.
Okay, Julian, so with this in mind, what's the word then for where we go, where the keen money goes as we go into the meat of 2021 and beyond? What are you looking at as a chief investment officer as opportunities to invest in the market?
I was just going to touch one point I was going to make on Tom's comment about consumer.
Sure.
I think it's beholden on the government to boost consumer confidence as well, because Tom's absolutely right that a lot of money sits with the wealthier end of the spectrum who may not rush out and spend that money immediately. And it requires that people to gain confidence about a recovery to boost consumer spending. In terms of where we're looking, we're looking broadly at equity markets, but tending currently to look at the strength we've seen in sterling against the dollar to place some funds outside of the UK. So we still think that there's some very interesting opportunities in the United States. I mentioned earlier that some of the large tech names have had a pullback. There's opportunities possibly to look there again, where there's a great breadth of opportunities for investment in technology and growth companies. Also in the small and mid-cap area in the US, as the US economy picks up. There's, if you're looking for more cyclical value, Japanese market offers some interesting opportunities, particularly strong in some developing AI and robotic technologies. So again, some interesting areas there. And finally, in Europe, you need to be more selective. I'm slightly nervous around the financials, but I think other areas are interesting. You just need to keep a close eye on the euro to make sure it's not strengthening too much, hitting exporters, but opportunities there as well, but more in Northern Europe than in the Mediterranean regions.
Okay, look, we'll have to leave it there, but thanks indeed for joining us, gentlemen. It's been a pleasure to catch up with you and your thoughts on the market risk for 2021. That's Julian Chillingworth, Chief Investment Officer at Rathbones, and the UK economist at Capital Economics, Thomas Pugh. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.